Thank you everybody for joining into this session. Today we are going to talk about rental or specifically real estate investment in US and specifically focus on rental properties. And just to give you a background, what prompted me to have this seminar is that over the last couple of years, I have been talking to so many people, and one common thing which I observed is that most of the people have some rental properties, uh, or they are very much interested in getting rental property investment. And primary driver behind that is recent surge in property prices. And so that is primarily reason, and they are then seeing everybody else is doing it and how people are telling their stories about how much benefit or how much appreciation they are having, and all that is prompting people to think or that invest in real estate property or rental property is very lucrative. So no doubt it has its own place, and it's a valid asset class for investment. But I'm going to give you a real perspective which is based on data and numbers, and also the Krishna conscious perspective of this whole thing, and see whether it really makes sense or is it really worth the pain and the effort which goes into it. And then you can have a more informed decision about yourself, whether you want to go into it or you want to live with some alternate options. So that's what we are going to talk about today. So just to give you an idea that this is not target audience for this is common non-professional real estate people like you and me, who are not real estate professional. They are like doing their other job or something, but they are having one odd or two odd properties which they are thinking or already have as retail investor. And as I already mentioned, those who are getting carried away by recent surge in property prices. And this session is not for professionals like real estate professionals whose main job is to deal in rental properties, or high net worth individuals who are consciously diversifying their assets into real estate rental properties. So this session is not for uh, those people. So what we are going to cover today, now let me share my presentation. So we are going to cover today why people invest in real estate, like what are some of the motivations, and you can share your own motivations, like why you think or why you have already invested in real estate. Then we will talk about ways to invest, what are the different avenues available to invest. And then I will going to present you a financial case study based on current market scenario and look at the numbers and see how much returns we can expect if we invest in real estate property or rental property. And then we look at history and see how historic returns have been over the past 70, 80 years. Because as I said, most of the people are getting carried away by the recent surge in the property prices. So we have to look at that thing in whole, like longer term perspective, because we don't invest in any real estate property for 1 or 2 years of quick gains. It's a long term investment. So then we have to also look at the returns over a long period, not like just a short period of time. So then we look at those, and then we will look at other things to consider while investing, like what are other aspects which we have to look into other than just the financial aspects of it. And then we'll look at some alternatives, like let's say if somebody is not ready or somebody is not motivated and they think that okay, real estate or rental property investment is not for me, then what are the other avenues available where people can still invest, get some returns, and fulfill their financial goals. So let's answer that question first. Why people invest in real estate? So if anybody wants to unmute themselves and say, if you are already invested in real estate, then what was your reason? Or if you're thinking, then what is your motivation? So I would really appreciate that before I share my points.
At some Hare Krishna Prabhuji,
Yes.
Nitin here. So at some point of time, whatever the property we buy,
Mm-hmm.
it gets appreciated, and that is the main reason. Like even if we keep the property, we are not using it.
Mm-hmm.
Still, and the value of the property it increases, I suppose. Like
Yeah.
that is the main motivation.
Okay. So appreciation, like appreciation of investment. That is the motivation, right?
Correct.
Okay. Any other?
Hare Krishna Prabhu, this
Yes.
is Das.
Yes.
To build some passive income.
Yes. Rental income. Yep. That
Mhm.
is one reason. Primary motivation. Yes. Any other? Okay. So
It is a kind of asset where you can,
yeah.
pass on to
Right.
your
Right. So this is what I have listed down. I think that should summarize everybody's opinion. If anybody has any other, then just let me know. Unmute yourself and let me know. So first and foremost is like it's a tangible, like it is a property, it's a physical thing which you see in front of you, whether it's a house or a land or something. So it's tangible. Second, as Nitin mentioned, it's appreciation over time. Third is Krishna Prabhu mentioned rental income, passive income over the life. And then as Kishore Prabhu mentioned, that is state purpose, like building the asset for the lifetime, and which you can use in your lifetime or pass it on to the next generation. So these are the primary factors why people think or invest in real estate, right? So now let's answer this question. So this is the goal, like this is why. Now for what goal you are investing in real estate. So what life's problem or what life stage you are going to realize it. So any thoughts on that? So let me give you an example. So for example, somebody says rental income. So if you are getting a positive cash flow, then it's going to help you in your, let's say in your retirement, you are thinking that I will have another source of income. So that is one goal. So like that, what other goals you have? Like what problem or what financial issue this property is going to solve for you?
So Hare Krishna Prabhu.
Yeah.
Again, let's because the uncertainty of the job in US, like
Hmm.
and getting laid off, and then
Yeah. Sorry, you cut off. Okay, we lost his
yeah,
voice.
sorry,
Yeah.
sorry.
Yeah.
So the fear to lose a job, and while losing a job, the source of income is entirely blocked. I
Right.
mean, and again, with the rental property, at least we have that in mind that for few months which we want to survive, at least there is a source, there is a cash inflow which is coming, and I mean, with the uncertainty over here in US, where the layoffs and
Right.
the
Yeah, I got your
the
point. So yeah. So we'll
that
dispel that myth because it's a myth. Yeah. So I will talk about that in future slides. So basically these are main financial goal everybody has in their life. Like either you want to save for kids college education, you want your own retirement income, or you pass on the inheritance. These are the like non-negotiable, what you can say are most prominent goals. Like then you can have other goals which are more like a wants basis, not the need basis. But everybody who is a grahastha, who is having a family and kids, these are the things basically he's looking for, that he want to accomplish. So when you invest in real estate, are you making sure that any of these goals are going to get fulfilled with that property investment or any other, not apart from these three, or you are going to just become a paper tiger? And I just coined this term because I couldn't find anything else. So that means that on paper you are looking like a millionaire, or you have two properties, three properties, four properties, and you are a multi-millionaire maybe. But is it going to solve, or is it solving any of your current life financial problems? Is it fulfilling any of your goals in the most efficient way? And you may not have the answer to it right now, but by the end of the session, hopefully you will get a full perspective by which you can judge yourself and see that is my investment is going to solve any of my current life financial problems. Okay. So quickly, what are the various ways? So rental property is just one. So as I listed here, that you can invest in just plain land, which is a raw land. It could be developed, undeveloped. You could have a rental residential property. You could have some passive partnership investments. I see many people are doing that as well, where they just invest few hundreds, thousands and dollars in partnership, and where they just get passive income. They are not owning any property. They are not managing any property, but they are just simply investing as a passive investor. Then there are people who are doing commercial syndicate investment, like which is for the high net worth individuals, uh, called as accredited investors. They have like more than $1 million net worth and more than 200K yearly income. So these kind of people invest in commercial syndicate investments as well. Then for retail investors, another way to invest is in REITs. It is just like ETFs, real estate ETFs, where you get dividend incomes every year. So anybody can invest in it. There is no minimum threshold or maximum threshold on it. Or then at last, there are people who took this as their full-time profession. So they are acting as a real estate professional and they are doing this job as their full-time occupation. So what does generally people are doing, in my observation, which I have seen, is that we buy multiple homes over the lifetime and keep converting our earlier home as rental. That is very common scenario, that you start off with a smaller house few years ago, and then you realize that, oh, I need to upgrade or I need to change, or you had a change of job, change of city, and then you end up moving into another home. And then instead of selling old home, you thought of converting it into rental and buying another one. And that's how you keep adding, like either you have just one rental or you keep adding 2, 3, 4 like that. Or let's say you get some good income, you got good saving, and since you don't have any investment plan, you did not invest it anywhere, and over a period of time you got uh, cash accumulated like 100K, 200K, 400K. Now you have that cash sitting and you don't know what to do because you don't have a alternate financial plan. So then default choice would be that, hey, I have this money, what to do? Let's buy another property and or do some commercial syndicate investments or a passive partnership investment, and let's use this cash. So that is another way. But in most of the cases which I found, that generally not much analysis or calculations are done. These first 2 points are the primary thing. Either you move out from the home, so you convert earlier into rental, or you have surplus cash, so you thought, okay, let's use it into some real estate investment. That's it. And then next thing is that blind belief that it's always a fruitful investment. Somehow there is a psyche, or that is this notion in our mind that in real estate we can never lose. If we buy a property, it's always going to appreciate and we're always going to make profit. So it's always a fruitful investment. So there is no loss or there is no harm in doing it. Or most of the times then we get influenced by the herd, what other people are doing around us, and that influence our decisions. And most of the people does not know long-term tax consequences, etc. They don't think that 20 years, 15 years down the line, what's going to happen when I'm going to sell this property or how I'm going to come out of it. Because no investment plan is a good investment plan if you don't know the exit plan. If you don't have the exit plan before investing into it, you don't know how you are going to come out of it, then it is not a good investment. It's a very basic principle of investing. Whether you're investing in a 6 months fixed deposit or you are investing in real estate, you are investing in stock, brokerage, life insurance, whatever form of investments you are having, if you don't have the exit plan, if you don't know when you are going to exit from it and how you are going to exit from it, then it's not a good plan. So in case of real estate, I don't think people think about that. They just do it without knowing when and how they are going to come out of it and what's going to be the impact when they come out of it. So just a word of caution on partnership and syndicate investment, because I have been seeing, I filed so many tax returns last year and I have seen this very common nowadays. So first and foremost, it's not for retail investors. Even if somebody says you invest 20,000, 30,000, 50,000, you don't have to be accredited investor. still I would highly, highly recommend any retail investor, small retail investor to invest in it. Just
Hey,
keep away from
guess
it.
what?
Okay.
Security doesn't have a key to that closet.
So then second problem with this is very less liquidity or no liquidity at all, because most of these investments are long term. So you don't have any liquidity or easy exit plan. And as I said, without exit plan, if you don't know how you are going to come out of it, it's not a good investment. Third thing is that you don't have any control, because you are just a passive investors in this. So you don't have any control at all where the money is getting invested, how it is being managed, what are the profit it is generating. You don't have any control or any say in it. You are just a passive investor on the sideline, and whatever general partner decide or gives, you just have to live with that. And I have seen few cases where it has turned into 100% loss. Though it is a real estate investment, though it is a common pool real estate investment, but people have lost 100%, even their principal into it. And then there are various compliance and tax issues. There are so many organizations or so many LLCs and things like that which are formed, which are not following proper rules and regulation, and they get into legal trouble. And if they get into legal trouble, your entire investment is blocked. And then you can't do anything about it until that is clear. So my humble suggestion to small investors to stay away from it, not even look at this direction. Okay. So now let's look at simple case study for rental real estate property, because that is our main focus. And I'm focusing it based on the current scenario to give it proper perspective. And obviously numbers and figures will change based on the individual situation, but this is just a simple case study to put things in perspective and to create awareness about what all you should look into when you are investing in a rental estate property. So in this case study, let's see the purchase price of the house is 400K and you are using a loan, because most of you talked about having a passive income. You cannot have a passive income unless and until you have a positive cash flow from the property. And if you are buying the property on loan, that means you can't have a positive cash flow from the beginning. It may take years before you turn into a positive cash flow. And if you are buying the property without loan upfront, then you have to look at how much you are getting returns, because let's say you are putting 400K and you are getting 2,000 rental income on that. How much return are you getting? You are just getting 6% return. So is it worth? And we're looking at all other costs and other things which we are going to talk about. So you have to look at from that perspective, because if you are buying everything upfront by paying whole thing, then there are other ways where you can invest that money and still get that regular income if you want. So let's assume that you are doing it on loan, because that's what most of the people do. I hardly see a rental property which is loan free. Most of the time it is under mortgage. Let's say you are putting 20% down payment. Current interest rate for 30-year loan is on an average 6.5%. It's little higher, but I have to consider 6.5. And then you will have approximate 6,000 closing cost when you are buying a new purchase. And then let's assume that you are buying a very good home, which does not need, or a brand new home, which does not need any repairs. Because if it need any repairs or any upkeep before you rent it out, then those would be extra expenses you need to account for. But in this example, I assume that its property is in pristine condition and it is ready to move. Now let's see what are the recurring expenses you are going to have on this property, rental property. First and foremost, you will have property tax. Here I am assuming just 1%, which is $4,000, and which is going to increase 3% annually. In most of the states, it's even more than that. Some states have 2.5% property tax. So you have to see that in the state which you are living or where you are buying the property, how much is the property tax. Then you have to take about home insurance. Again, depending upon where you are, in which area you are, it can be much more. I have taken a very basic average of $1,200. If you are in Texas or in Florida or in states where hurricanes and hailstorms are common, then this price can be even much higher. I just recently got help one person closing a house, like 400,000 house in Texas, and there the total insurance is minimum $2,000. But let's say it's of $1,200 and annual increase of 3%. Then you have to take into account HOA fees. Now, if it is a single family home, average HOA fees could be around $100 per month. So I have taken it as a 1,200. But if it is a townhome, then HOA can be much, much higher. And in some cases, it may be around $500 per month or $600 per month, like that. So that would be a very, very big cost. Then you have to account for maintenance cost. I have not taken any maintenance cost here, assuming it's a brand new house. And let's say for 5-10 years, you don't have to do any maintenance. So I have kept it 0. But in a rental property, even if there is a slightest problem, renter is not going to compromise on that. His flush is not working, his garbage disposal having some issues, his door is not closing. Whatever smallest issue is there, as a homeowner, you can live with it, or you can try to fix it yourself, or you can just work around it, and you may not make much out of it. But on a rental property, somebody is not going to compromise. Even a slightest problem, he's going to report, and then you have to do maintenance on it. And then there are some other costs, like if it is a lawn mower is there, or you have to do pressure wash every year, you have to do gutter cleaning every year. So like that, there could be some $500 maintenance cost like other cost every year. Now let's talk about income. What income it can generate? So let's say monthly rent is $2,000 per month on this, and you will increase the rent by 3% every year. Now this is the very optimum rent which I have taken. Because 6%, because if you look at 400,000 property and you are taking 2,000 rent, it's like 24,000 rent in a year, which is like 6% yield. So which is on the top end. Normal rental yield in US is 4.5 to 6% range. So I have taken at the top end. So let's say you are getting 2,000 per month rent on it. Obviously no other income. You have to account for the vacancy rate, because let's say if you don't have a long-term renter and every year renter change, then you have to have a house vacant for at least a week to find a new renter, do the cleaning, move out, move in, all those kind of things. So very minimum 5% vacancy rate, which turns to be like 2 weeks per year. So let's say your house is not rented for 2 weeks every year. And then management fee, very minimal I have taken here, because in most cases, let's say properties in some other city or other town, or let's say you go back to India and you still have rental property in here, then you have to hire a management company to manage it, because then you yourself cannot do it. And if you do it, they cost 1 month rent per year as a management fee. That turns out to be 8%. Here I'm assuming that you are doing it yourself. You are just doing some paperwork at the beginning of renting out, and some credit check, and writing out the agreement, getting it signed, doing the background check of the rentee. So in all that, you may spend like 0.5%. So again, very minimum, but as per your situation, you have to see how much is the real management fee, because it can go as high as 1 month rent, which turns out to be 8.33%. And now let's see that at some point you are going to sell this property. That's what we bought it for. We are not going to keep it forever, right? So let's assume that I don't know the sale price, what's it going to be in the future. So let's assume that value appreciation would be 3% per year. Again, it is an average value appreciation, and we will talk about it later when we see the historic return over the last 70 years. So don't get fooled by the recent surge in property prices where you see 10, 20, 30% appreciation in a year. It's not sustainable. It's just one odd event. And if you look it over a period of 10 years time, then it gets normalized. And then let's say you hold this property for full 30 years, and then you sell it. And at the time of sale, you have to incur cost again in agent commission, seller credits, and then keeping up the property to make it sale ready and things like that. So this is what the numbers looks like. Don't get overwhelmed. I will explain it. So let's say for whole 30 years, main thing you have to focus on is cash on cash return column, this column, and then the last column, which is IRR. If sold at year end, then how much return you are getting. So as you can look at, cash on cash return is negative to start with, and cash flow, initial cash flow is 86,000, like 20% down payment and 6,000 closing costs. So that will go out of the pocket as soon as you buy the property. And then after that, every year you have to shell out this many dollars, like 8,485, then 8,012, then 7,524 out of your pocket in order to keep this property on rent. And then only on year 15, okay, I'm not too sure why that message come. I'm logged in as admin. Okay, so maybe I have to switch the login. So bear with me. Okay, I will just finish this slide and then probably we'll switch over. So if you look at this, then in the year 16, you are having a positive cash flow. That means at that point, you are not paying anything out of your pocket, and then you have positive. That means at that point onward, you are having a passive income. Before that, you are even paying out of your pocket to keep this property. And then if you look at the IRR return, IRR stands for internal rate of return, which takes away all the cost and everything which you are putting in. So it gives you the net return after all the cost and everything. So as you can see that over a period of 30 years, the average rate of return is like around 6.5 to 7%, close to 7% if you keep it beyond 20 years. But in initial years, like initial 10, 15 years, it is close to 5 to 6% only, not more than that. And other factors which I have not taken into account, which you need to think about is returns are absolute without tax impact. So this does not take into account any tax impact, like how much tax it's going to cost when you sell the property, or how much tax you're going to pay on the rental income if you get the rental income. Now, there are ways you can dodge the tax by making up some false number and things like that. But if you do it properly without manipulating any numbers, then you have to take into account both rental income tax as well as the tax on when you sell the property. It also does not include any refinance cost, because you may say that, okay, 6.5% is the loan rate right now, but over the period of time, it may go down and I will refinance the loan. So then it's going to reduce my cost. And yes, but then it will also cost the refinance cost. You have to do appliance replace, you have to do major innovations like roof replacement, kitchen bath remodel, new carpet, new flooring, every 10 years at least, if not more frequent. Like roof you can do like 20, 25 years, but over a life of the property, at least once you have to do all these major renovations as well. Otherwise, you will not be able to rent your property, because every 10, 15 years, the aesthetics and everything completely change. And as I said that IRR is in single digit. It's not even beating a long-term average returns of the equity market, which is in double digits. So it's not very handsome return. And even a permanent insurance policy can give you better cash on cash return. If you look at the cash on cash return, as I said, you are breaking even after 17 or 18 years. Then you are having a positive cash flow. And it's a very expensive investment to manage, because you are having 3 to 5% fixed cost to manage this investment. Let's say even if you don't have any income, even if you don't have any rentee to rent out, market goes down or you don't find a renter, then also you have to incur these costs like recurring operating expenses. You cannot get away from it. So that is minimum 3 to 5% expense, like 1% in property tax, 0.5% in home insurance, 0.5% in HOA fees, other costs. So all this is recurring cost which you have to keep paying no matter what. So this is like any investment you have, like even if you have a managed equity investment, it costs like 1%, 1.5% management fee. Even if you have a permanent life insurance, over a period of life of the policy, the average cost of management is like less than 1%. But here you are paying 3 to 5% cost per year without any leeway, because it is must. You can't do anything about it. Okay, so yeah, so as we are discussing, this is the sample case study for returns. So even if you look it from only financial perspective, this is how you have to look into it and do the calculation and the math to see how much you are getting on your investment. And based on that, then you should see whether it fits into your overall financial goals and the picture or not. So any comments or any questions so far? Okay, so then I will go ahead. So let's look at the average historical returns on real estate housing market.
Hare Krishna Prabhuji.
Yeah.
Can I ask you one simple question?
Sure, Prabhuji.
So you're saying this is about if you're taking this the rental property on a loan,
Yes.
but if you, in a case where you already have a home that's already paid off and now you're moving into a bigger house, is
Right.
that case going to be covered later or this is
No, so for that I can give you a very simple calculation. Okay. So
Yes.
as I said, rental return you get maximum 6% in US. No, wherever you are living, that is I think the maximum, unless and until few exception where it's like a condo in a very big commercial city or something like that. But even in that, I won't think that it will be more than 6%. So let's assume you are getting 6% rental yield. And as I told, that 3 to 4% are compulsory charges you have to pay every year, right? So then that means your net return on rental is only up to 2%. And now let's say property is appreciating on an average by 3 to 4%, or maybe let's up to 5%. So then 2% plus 5%, you are getting 7% return on your capital.
Yes,
So, or you have an option that let's say your house is completely paid off, it's worth 300, 400, 500K. And if you sell it, and I will talk about the tax benefit of that, then can you invest it somewhere where you can get more than 7 to 8% return? And answer is yes.
Okay. Yep. Thank you, Prabhu.
Yeah, so that also you have to take into account. Yeah, and then non-financial reasons. I will going to talk about a lot of non-financial reasons which are also you have to take into account, because right now we are just talking about the numbers, but we will focus on non-financial aspects of this as well in a couple of minutes. Okay.
Yes, Prabhu. Thank you.
Yeah. So here, if you look at decade by like from 1930 all the way up to 2000, if you look at the rental property returns, so here you can see the dark blue is the nominal housing price return. That is means exact point-to-point return. For example, your property was 400K and in after 10 years, it has become 600K. So that is like 50% return. Okay. So that's what dark blue line represents. The light blue line represents real return. That means adjusted for inflation, because property prices will increase due to inflation naturally as well. If current economy inflation is higher, then property price will appreciate much higher, because the cost of labor, the cost of material, everything is increasing. So that will get reflected into the price of house as well. So if you look at the blue, light blue bar, that gives you the return which was generated in that decade on a real basis, means minus the inflation. And if you can see that in 70s and 80s, and those who of you attended my last session, we discussed like how in late 70s and early 80s, the inflation in US was around 18 to 20%. So you can see that this dark blue line is much, much higher, like 131% return in 10 years, and then 77% return in 10 years. So that most of it is accounted for because of inflation. Because if you look at real returns in that decade, that is just 27% and 13%. Now let's look at most recent, like 2020, 10 and 2020. So even if you look at the current, we are just 4 years into this decade, like from 2020 to 2024. And if we compare it with last decade, we are almost there. Means whatever returns are generated both in real terms and inflation adjusted term in last whole decade, the entire those returns have already been generated in first 4 years. So that indicates that market is very, very inflated right now, the housing market. And everybody knows that, because in last 4 years, we have seen unprecedented rise in housing price. So it's not going to be sustainable like this. Like even if it goes like this, like in 70s and 80s, then it is going to come at the cost of inflation. So let's say inflation is right now is coming under control. They are saying it's around 3.5%. But let's say if it turn around and it again shoots up to 9%, 10%, then yes, property price may shoot up again, and it may even go further up. But if you look at inflation adjusted numbers, that will get normalized to this around this figure over a period of 10 years. So if you look at any 10-year period, the real return, like inflation adjusted return, has never been more than like, it's almost like 27, 13, 20. So it's like, I would say average 20% return, 25% return over a 10-year period. So that is like 2% real return on a yearly basis after inflation. Now, if we look at simple equity market return, average return on any 10-year period, and this is just for S&P 500, simple, so again from 1930s to all the way up to 2000, like latest. As you can see that average return has been 10.32%. And only time you have a negative return was in 1930s, because that was the World War I and Great Depression. 1935, we had a Great Depression. So because of that, you see this at the start of the graph, first 4 years, you see negative return. And then after that, 10-year rolling negative return has came in year 2007, 2009, because we had 4 years of negative return from 1999 to 2003. So the 10-year rolling return in that case has been negative in equity market. But over the history of 60 or 70 years, that has been only 2 years in which on a 10-year average basis, you have a negative return. But on an average, you have 10.32% return. And most of the time, 10-year rolling average has been like 4% plus, 5% plus, which is more than real estate. So then what other factors we should consider? Because as I said, that was just the financial picture. Like just by hard numbers, we have to look at like if it making sense. Now let's say based on some individual situation, when they bought the property when interest rates were 2% and their current mortgage is very low, and the property tax and maintenance and HOA fees are very low. And based on that, still it looks like lucrative. Like, okay, I'm getting a good return, so I want to have it. Then, okay, financially it's making sense, taken. But then what other things are going to affect us? So anxiety in case of any long vacancy period. So let's say if you have a loan, then all your loan and all your fixed costs, everything is going to be paid every month, no matter what. If your property is on loan, if you miss 2 loan payments, you will get a foreclosure later. If you miss property payment, you will get penalty as well as interest. So all those have to be paid. So as long as your property is rented, then at least you have some cash is coming and then you are able to manage it. But let's say for some reason due to recession or due to change of economic scenario, whatever, if you have a long vacancy period, then either you have to reduce your rent or you have to go with a long vacancy period. And then that will eat up all your cash because you have to still keep maintaining the property. And as I said, you have to upkeep and renovate every 10 years at least. You have to change the carpet every 7 to 10 years minimum. You have to change the appliances after every 10 years. You have to change the flooring. You have to do the painting. So many things. After 20, 25 years, even windows need to be replaced because what they are constructing in today's time, the lifespan of that is maximum 40 years. And that is a documented fact that today's home which are getting constructed will have maximum lifespan of 40 years. That means you have to do a complete flip on that house after that. And then you have to deal with insurance, property tax, maintenance, tax filing, HOAs, tenant management, all that on a constant basis you have to do. If you are planning for inheritance, then you have to take into account all the trust, LLC, everything is in place because let's say you have 3-4 rental properties, your children are minor, you don't have any will in place, you don't have any trust document in place, and if anything happens to you, all of a sudden, they will be in a big trouble to settle all this matter. You don't even realize how much trouble they have to go through to get all these properties settled. Then there is no immediate tax saving unless you qualify yourself as real estate professional. And that is another alarming thing I have observed when I was filing tax returns, that most of the people are falsely claiming rental deductions. They are claiming themselves as real estate professional, and they are taking all the losses on their rental properties, whether they are from India or they are in US, and they are getting the deduction. If any audit happens, it will be a big problem, because that is not legitimate. You can qualify as a real estate professional only when you spend more than 700 hours of your time in managing those properties. And along with a full-time W-2 job and other things, I'm not sure, and just for one property or a couple of properties, who can justify spending more than 700 hours in a year in just maintaining the properties? So that means that deduction is being taken in a wrong way. If you do it in the right way, then there is no immediate tax saving, because this is a passive income, and passive income can be set off against passive loss. You cannot set it off against active income or active loss. So what you are earning from your W-2, what you are earning from your other business, that is active income. So any income you are generating from that, you cannot write it off against your rental loss. Then, as I told you, positive cash flow depend on several factors. So you have to wait maybe for many years before it can really generate any positive cash flow or real retirement income for you. And as you get older and older, and if you're depending on the rental income in your retirement, it is going to pose even more challenges, because once you get older, it's even more difficult to take care of all these factors. And then, as I said, in case of any untimely death, it's going to be a big headache for family. And if you are taking a rental property on loan, then you have to have extra life insurance to cover its cost, because you don't want your family to be in big trouble if anything happens to you and you have 2 or 3 rental properties on loan, and you are assuming that you will pay it off by rental income. And if anything happens to you, family is in trouble right away, and you don't have any life insurance to cover the cost for those loans. So then it's going to be a big headache for them. So I will take questions after this next slide. So some more factors to consider, like by investing in real estate, and again, as I said at the beginning of the session, it's for retail investors, those who are having 1 or 2 rental properties. I'm not talking about big guys. So you restrict your option choices and flexibility, because this becomes one of your biggest investment. Let's say your total net worth is 1 million, for example. That includes your primary house equity, that includes your rental property, and apart from that, you have 401k, which is already locked. Then, if you take all that aside, what is real net worth or real liquid cash you have, real liquid assets you have? Close to nothing. And if you look at your overall portfolio, then it looks like 60 to 70% of your assets are in real estate. So that means you have asset concentration. Most of your assets are in only one particular asset class. And if anything wrong happens with that particular market or in that particular asset class, then it's going to affect you in a very big way. Or you have a balanced portfolio, like balanced asset allocation, where you have 20 to 30% in real estate, 30% to 40% in stocks, 20 to 30% in bond and cash. So if you have that kind of very well diversified asset allocation, then even if one thing goes down or up or face some problems, at least you will not be in a big trouble, because the other things will most probably will move in a different direction than the one from each other. So it will balance it out. Then, as I already mentioned, it has a high maintenance cost. If you keep that property, even if it is generating income, you have a bill of 3 to 5% every year, no matter what. It has a high transaction cost. You can't buy, sell, refinance just like that. Any time you have a transaction on the property, either you are buying or you're selling or you're refinancing, you have to shell out extra dollars to carry out that transaction. Most important is the liquidity issue. You cannot get money easily when you need it. You can't take out $10,000 from your rental property if you need in kind of any emergency. To Nitin Prabhu's question, he said that, oh, we'll have the safety if we lose the job. Yes, you will have that safety only if you have positive cash flow from the property. So first thing to take care of is that you have a property on which you don't have any loan, or even if you have loan, then you have enough cash flow from the property, which will give you that safety that even if I lose job, I can carry out on my family for a few months. But on a loan property, you definitely cannot have a positive cash flow. And if on a fully paid off property, if you have positive cash flow, then you have to look at the cost benefit analysis. As I said, like on a 400K property, if you have that 400K in cash, like liquidable assets like stocks, markets, or life insurance, or things like that, where you have flexibility and liquidity, you can take out any money which you want. But even if you have a rental property which is paid off, you can't just take out 10,000, 20,000, 50,000 from it if you need it. Then tax uncertainty and inefficiency. I said inefficiency because you cannot do this transaction piecemeal. Then any property you have to sell full. You can't sell 5%, 2%, 10% of the property. And whenever you sell, yes, you are lucky. Yes, you made big profit, but it's a big profit in one single year. Whatever you earn, 100K, 200K, 300K, that is going to come out as a one piece in one transaction. And then the higher the profit, the higher the tax implication is going to be. And you cannot get away from that. And that will all depend on what the tax rules in that year in which you are selling the property. Take the example, just like few days ago in India, all of a sudden indexation benefits removed from real estate this real estate transaction. Now anybody sells today, they have to give the tax based on the difference of the purchase price and selling price. Even if in real terms property has depreciated or you made loss in real terms, inflation adjusted, still you have to pay tax. And then no emergency protection. Rather, it's a more risk in emergency if you have a rental property, because as I said, it has a fixed cost. If you face with an emergency, you cannot rely on rental property for you to come out of that emergency unless and until you sell it. And if you sell it in emergency, you are desperate, you are anyway compromising your return because you can't sell it on your terms. It's an emergency situation, you have to do a fire sale, and fire sale is always going to be not in your benefit. And even in that case, you're not going to get your money in like 2 days or 1 day or 1 week or something like that. Minimum period is like 30 to 40 days for a real estate transaction. So even if you have an emergency, it will not wait for 30 days for you to get money out of this. So what are the alternatives then we have? So best one alternative we have is that like those who have sold, who are in an old house and then move out to the new house. One big thing which they missed out is that, I don't know how many of you are aware, like if you sell the house in which you are living or you occupied for 2 years in last 5 years, you don't have to pay any capital gain tax up to 500K gains if you are married filing jointly. So that means on every house, you can unlock up to 500K, $500,000 worth of capital completely tax-free. And it's a big, big thing. So let's say if you are living in a house which you want to upgrade or you want to move out, and if you sell that house, let's say you have 100K, 200K property appreciation on that, then if you sell it within 2 years of moving out, then you can unlock all that capital gain completely tax-free, and then you can reinvest it whichever way you want, either in property or you can invest it in your new house, or you can invest it outside, completely tax-free. Then other alternative is regular equity investment, which are more flexible, more tax efficient, and you can get regular income from that in early retirement as well. And that is completely flexible. You don't have any timeline limit on that. You don't have any high transaction cost. You have full flexibility to sell it any point you want. It's a capital gain tax, which is lower than the ordinary income tax. So you will have some tax efficiency, and you can do it piecemeal. So you can just take it out as much as you want, and you can plan it more tax efficient way, depending upon your tax bracket and all those things. You can decide how much I want to take it out rather than selling out your entire portfolio in one day. That's never been the case. If you are very conservative, you think that, oh, I can't handle stock market risk. It's so much up and down. I really don't want to get into it. Fine. So for more conservative or moderate investors, we have permanent life insurance policy, which have a net IRR of 5 to 7% with no headache, no tax, and better cash on cash return after 5-7 years. And then let's say even after all this, you are convinced that no, real estate is still the thing. I will make returns in real estate. No matter, like I'm fully convinced. Then you can use it REITs. And REITs comes in a various forms and shapes. You can have commercial REITs, you can have health sector REITs, you can have retail REITs, you can have multi-family house REITs, or you can have mixed bag of everything. So it is just like stocks. You just buy it, you keep it, you get dividend income every whenever dividends are declared, and you get appreciation also if the underlying properties are appreciating. It's transparent, it's flexible. You can sell it out just like stocks anytime, and it gives you indirect way to invest in real estate. Very, very convenient. And last point I want to highlight that if we look at more philosophically, then this is not Krishna conscious, because housing is a need for everybody. Every human being needs a roof on their head to live peacefully, and it's a limited natural resource. And the more somebody hoards it, it means we are depriving it of others. More and more people will be either forced to live on rental, and we know the feeling of living on rental. That's why we become a homeowner, and we don't want anybody else to go through that same situation. Now, in current market scenario, there are so many people who are living in rental. They want to buy a house, but they are not able to buy the house. Why? Because there is a shortage. The demand is not as much as, like, demand is much higher than the supply. But and it's again a documented number. Like if everyone sells the house, extra house they are having, then housing shortage will go over right away, because there is a shortage of over 2 million houses across the US, and 2.8 million houses are being held by investors, like those who are having more than one houses. So if they all put their houses in the market, extra house in the market, then there is no shortage. Everybody will have home. And that will give better price stability, better market, and overall very peaceful society in a long term for everyone. So these are some of my thoughts I wanted to share on this topic. And at the end, I just want to appeal to everyone, like those who are inclined and inspired. If you want to save cows, then my Guru Maharaj project is there in DeLand, Florida, where there are 15 cows which are being taken care for their lifetime. They are not milking. They are being taken from slaughterhouses, and we are taking care of them for their lifetime. And we need to build a cow barn for them, because right now they are living just under a temporary shade. And there is a lot of expenses to feed them, because there is not a lot of green grass around on the property because of sandy soil in the Florida. So if you feel inspired, then you can make your contribution either Zelle or PayPal to info@vedafoundation.net. And my contact details, if you want to get in touch with me for any further discussions or questions.
Prabhuji, Hare Krishna, Prabhuji.
Yes, Prabhu.
At least we will have that. Thank you. Hare Krishna.
Okay. Yeah. Okay. Sanjay, you have raised hand. You have any question?
Yeah, हेलो
Yes.
अच्छा, तो एक बात बताओ, अगर इसको लैंड में इन्वेस्ट करें
Yeah.
तो क्या?
Land mein, if you do, then again you have to look at various factors, especially in US. If you are doing it in land, then you have to look at the land size, like land where it is. Then you have to look at the zoning, and then you have to look at the county rules. Then you have to look at the flood zone. Then you have to look at neighborhood. Then you have to look at future prospect, like if any highway or any high tension power line or anything like that can come through it. And then again, exit plan, because for what you are taking it, that question needs to be answered first, and how much you are putting into it, and how it's going to affect your other things, other goals, and other flexibility and everything else. So that you have to take into account. And after that, if it makes sense, then as I said, like you can go for it. But then again, that things will still be there. You will not have any flexibility. Selling land is more difficult than selling house, and you may not get the price point which you want because land appreciation is very, very dynamic. It depends on a lot of factors, other like as compared to housing. So you have to see the potential and you have to see how much return it can generate over a period of time and whether it will beat the flexibility and the convenience of investing elsewhere.
Hey, I have one question.
Yes, Deepak. Bro.
So, I mean, rather doing all of this and considering US economy has always performed over the decades, right?
Mhm. Yeah.
Why not to go for a total US equity market index fund or S&P 500 fund, which
Yeah.
historically has always proved it has worked. And in fact, when Mr. Buffett only owns one house and he constantly
Right.
advised people to put in S&P 500 index,
Mhm.
why to take a difficult route of flipping houses? And because
Yeah.
as you said, one of the things that keeps increasing in US is the property taxes and
Right.
the probability of you getting renting all the time.
Right.
When you add all of those and the stress that it causes, is it really worth, or is it better
Right.
to have low cost index fund from Vanguard and let it rot there for 30-40 years without you worrying a single bit about it?
Yes.
So
Yeah, that's what that's the exact point I was trying to make, means we have to ask ourselves, is it really worth investing in real estate and rental property? Because based on whatever facts I have shared, to me personally, it does not make any sense.
yep, I think I agree with you because
नहीं,
even
पर
when
उसका एक काउंटर पॉइंट ये है
हाँ,
कि सपोज आपने इंडेक्स फंड में पैसा लगाया है, ठीक है,
हम्म,
पर आपका सारा एसेट उसी में कॉन्सेंट्रेट नहीं हो जाएगा, फिर डाइवर्सिफिकेशन
no,
बचा
no.
कहाँ
So that's what I said. Like we have to have proper diversification because let's say even if you are putting all your eggs in one basket like index fund, that is also a risky proposition because as I said, from 1999 to 2009, even equity market on point to point in 10 years has given negative return. Even S&P 500, even though it's a US economy. So it's not a guarantee that if you put in US index equity fund, it is always going to give positive handsome return only. There are chances that it may give negative returns and for various reasons. So that's why we should have a balanced approach, and balanced approach is always beneficial in long run because no one asset class moves in one direction all the time. You will always have a balance in the economy because money flows from one asset to another asset. Whenever anything happens in the economy, people take out money from one asset class and put it into another asset class. So if one is falling, obviously the other will rise. If other is rising, then obviously the one will fall. So if you have, and in one of another session I have covered like what all ways you can invest. So that you have equity, you have bond and fixed assets, then you have permanent life insurance policies, then you have annuities. Like annuities are the fantastic ways to safeguard against any loss and still get better returns. Like you have guarantee that you will never lose your principal in annuities, and it's such a fantastic thing to have for a complete peace of mind. Like even if you are in market, if market performs, you will get return. If market does not perform, you will not lose a single penny. So then you have complete peace of mind. Even if market tanked by 50%, you are not going to lose a single dime out of it. And then you can have little bit of gold if you want. So like that, if you diversify across various things, then you will have a complete portfolio. I'm not saying that you go 100% in equity or you go 100% in bonds or you go 100% in real estate. You have to look at your assets. You have to look at your net worth. You have to draw out a map and see how you are diversified. Are you concentrated in one particular asset class more than 50%? Then it's a problem.
Yep, I think you said perfectly. Yep.
और एक की रिक्वायरमेंट जो अपनी रेंटल प्रॉपर्टी से मीट होती है, मतलब दैट्स व्हाई पीपल गो कि भाई मंथली एक इनकम आ रही है बिना कैपिटल को डिस्टर्ब किए.
So that income depends on multiple factors, as I told you. First of all, if you are buying on loan, then there are chances that you are hardly breaking even in first few years. Like yes, after 10 years plus, you can have positive cash flow. But in first 10 years, most probably you are just breaking even. Breaking even means whatever rent you are getting, you are able to pay off mortgage, property tax, and HOA fees and everything. It means you are not putting any dollar from your pocket. That's the max you can get in initial
नहीं,
few
अगर
years.
अपन ये माने एक सेकंड के लिए कि चलो मॉर्गेज वगैरह कुछ नहीं है, अपन ने
हाँ.
ले लिया और अपनी रेंटल इनकम आ रही है, सपोज $2000 पकड़ा अपन, ठीक है, उसमें 500 का खर्चा है,
राइट,
तो $1500 की जो आपको इनकम आ रही है,
हाँ,
उसमें आपको कुछ लग नहीं रहा है और आपका एसेट जो है उस वैल्यू का वो बना हुआ है, जो
so
पड़ा
that
हुआ
you
है
can
आपके
achieve,
पास.
that you can achieve through a proper balanced portfolio as well. You
Yep.
can have a regular income out of your portfolio, and still portfolio will keep on going up if market perform, because all proposition is based on the market scenario, right? In rental also, we are making an assumption that house property will keep on increasing and rental income will keep on increasing. I will have rental all the time. I will not have long vacancies. So based on all those assumptions, if you have a balanced stock market portfolio, that's how they say, like in traditionally in US, if you have a 60-40 portfolio when you retire at 65, then they said that if you take out 4% every year, you will not run out of money even if you live till 100.
नहीं, की पॉइंट है टेक आउट, है ना,
Take
मतलब
out,
आपको अपना जो स्टेक है वो सेल करना पड़ेगा, जो भी स्टेक है तो वो थोड़ा थोड़ा सेल करके आप लेते जा रहे हो.
right.
अब रियल एस्टेट में वही डिफरेंस है कि आप स्टेक सेल नहीं कर रहे हो, आप जो
नहीं.
उसको रेंट करके वैल्यू कमा रहे हो.
Yeah,
Huh.
but
after a year, you have to see that calculation which I showed, right? You have to see that how much real return are you getting at the end of the day. Because when I said, let's say your property means if you are getting positive cash flow, it means you have high capital, high equity in that property, right? So that means you are blocking all your equity there. Number one.
Yeah.
Second thing, as I told you, on rent, you will have maximum 2 to 3% positive return, and on house appreciation 3 to 4%. So on a long-term period, you can still not have more than 9% return on your rental, unless and until you have scenario like last few years where all of a sudden you get some windfall and your property appreciation. So that can happen in the stock market also. You can have a 40% return in a year in the stock market.
That is true.
Yeah, and I think one thing we are forgetting is when you talk about 65 years, the index fund doesn't get old.
Yeah.
The company gets replaced. It doesn't get old.
Yeah.
It doesn't need maintenance.
Right.
Their fee
Yeah.
structure doesn't changes. But house after 30 years is going to be so old that whatever you say yes or no, you have to constantly keep maintaining it, right? And then
Right.
you have to add those costs that you do for your
Yeah.
house. You brought a TV,
Right.
it's a cost for the
Because
house. You fix something.
yeah, because it's a high maintenance
बराबर
thing.
बात है.
Yeah, it's high maintenance thing and constant headache, because without putting money, you can't get money out of it. That, let me put it this way. But if you are having this alternate investments, then you don't have to put anything. Like even to generate income, you have to put something from your side. Without putting something from your side, you can't generate income out of rental property. But in alternative investments, you can still generate income without putting anything afresh from your side.
And I think Vikalpa has said REIT is other form, digital form of it. And
Right,
somebody else
digital
will
form of
invest in
real
it.
estate. Yeah, if somebody is
Yeah.
really convinced, that is the fantastic way to get exposure to real estate rather than getting all the headache on our head.
तो REIT में जो पैसा है अपन स्टॉक के जैसे बनाते हैं.
हाँ,
यूनिट
that is
खरीद
just
लो,
like a
बाजार में बेच
stock.
दो.
Yeah, that is just like a stock, and they are governed in a very different way. Like for example, they have to pass on 90% of their income in form of dividends every year. They cannot keep profit to themselves. So let's say you are buying a REIT of a multifamily homes. So all these apartment houses and all. In that REIT, let's say they are holding 10 multifamily properties and they are generating rental income, and after paying all the loans and everything, they are having some positive cash flow. So that positive cash flow, 90% of that, they have to give out every year in form of dividends. So that means depending upon the property performance, you will have dividend income every year. And then if property appreciate and if they sell out the property, move to a new property, whatever capital gain they get, those will also get reflected in the REIT price over a period of time. So that way, it's just like you are owning a piece, like just like a company. In a stock, in a stock, we are not buying the whole company. We are just buying a fraction of the company, right? So similarly, we are not buying the whole property. Why buy a whole house of 500K and put all our risk into just one particular house? Rather buy a house like 50 different house or 50 different properties, fraction of share in all those.
Hare Krishna.
नहीं समझा मुझे.
Prabhu, is there any good REIT resources you can suggest?
There are many, Prabhuji. I have not personally researched too much into it, because if you look at the equity investment returns versus REIT returns, the equity index always outperform them.
Okay.
So I don't see even a valid reason to perform in invest in
REIT,
REIT,
okay.
because if you look at this COVID time, all REITs fell flat. Those especially were commercial and all, and still they are struggling because so much is lying vacant, and
Yeah.
it's a
But
big
one
risk.
thing, one thing you suggest is tangible.
Yeah.
So
Yeah, you
that
can go. So you
tangibility is what I'm looking for.
right.
Something that is in your hand.
Yeah, right.
And I was looking for, I've been doing the investment in that, Vanguard equities and stuff like that.
Right.
But I was looking for some diversification.
Yeah,
And,
right. Yeah. So there are so many resources available if you want to research. So there are many REITs, as I said, which are very specific also if you want. So for example, people say that most safest is the healthcare, because no matter what happens, healthcare properties will not go out of business. Means they need physical space to run hospitals, to run clinics, to run the practice. So, and even bad economy or bad cycle or recession is not going to too much impact on them. So they are considered to be one of the safest REITs. So then we can look at REITs which are more focused on healthcare sector, which owns most of the healthcare properties like big hospitals and practice and retail locations where doctors are having practices. And that's why you will see that wherever you go, if you find a rental property, most of these doctors' facilities and everything is not in a independent storefront. You find that whole building is having different medical things.
Offices.
Because these properties are very much localized and specialized with one particular aspect. You will not find one storefront is having a saloon, and one storefront is having a doctor practice, one storefront is having a barber shop.
Okay.
You will not find something like that very common.
Yeah. And Prabhu, I live in Florida, and a lot of devotees here have property where they do Airbnb.
Right.
And do you have any exposure on that? Like, how does that
return? It's the same like a rental. It's a small, instead of full long-term rental, you are dealing with a short-term rental. That's it.
Yeah.
Okay.
So it brings its own implications, because short-term rental tax rules are completely different from long-term rental rules. So that brings another complexity. And you may get some higher yield because obviously you are charging more on a short-term rental than long-term rental. But then again, it brings uncertainty as well.
Yeah. Okay.
Yeah. So as I said, like all these may be good if somebody is like well diversified already and is still having a lot of money, and they just want to consciously diversify themselves, like say having some vacation home in some tourist spot or something like that. That may be a altogether different thing. But for a common person who are just living on their income, W2 income, and still they just want to go into properties one after another, that is the very serious trend which I observed, and I wanted to address that with this session, that if you are getting into it, make sure that you are weighting all these points before you get into it. Don't repent after 5-10 years that I made a wrong decision.
So like on a counter side, when does it make sense? कब करना चाहिए इसमें investment? कैसे मतलब कि it is profitable?
Yeah, it will make sense in two scenarios. As I said, this session is not for. So if you are that, then it will make sense. So that I will repeat. One is when you are a real estate professional. And real estate professional, I does not mean that you become a full licensed 100%, but at least you can justify and qualify yourself spending more than 500, 700 hours per year on this activity. So that means you are having like 4, 5, 6 properties spread across multiple states. And then you can form some tax efficient structure in terms of entities and LLCs. And then you can write off your losses from your rental properties to your other income, which you are generating out of other business or job. And that way, then you can have some more advanced tax strategy to take advantage of. That will then make little sense. Or second is, and again, it's when you are up to that point, then it means you are a high net worth individual where you have covered all your basics already.
Okay.
Like you are not worried about your retirement income. You are not worried about your kids' education. You are not worried about your normal day-to-day living being. You are not worried about any emergency. You already have a lot of assets outside of these properties as well. And since you have got too much that you just want to diversify into it, and then maybe, play around with it and build a legacy or estate. Because another advantage of having these rent properties, and which is the same advantage which you have in stocks as well, when you pass it on, then you get a step up cost basis. That means, let's say you bought a 300K property and then you die, and then
Okay.
property price was 600K on the day you die, fair market value. So then your children starting price will be 600K. So if you sell that property very next day after you die, then he will not pay any capital gain tax.
Got it.
So
Okay.
that is the advantage. But again, then you have to take into account like how much your estate will grow over a period of time. Because I have seen people personally, those who started doing all this in their 40s, and by the time they are in 70s, they have like multi-million-dollar property portfolio, and then you have a state limit, up to a certain extent only you have the state limit. After that, you have to pay state tax. So then now they are scrambling to figure out how to save state tax, because I will pass on these $13-14 million properties to my kids, and they will end up paying a lot of tax. And that's when fire sale happens, because when you see this all state sale board here and there, that's what it means. That means person has died, he has a state tax bill to pay, which has a 90 days period to pay off, and their children or inheritance don't have means to pay those high state tax. So they have to fire sell the properties to pay the tax.
Oh, okay. Mhm.
So lot of complications are there. Means it will occupy you even in your retirement full time. You can't have a peace of mind. You cannot enjoy. And ultimately, as I told in the before, like, what is the goal? What are you trying to achieve by investing in this property? As I said, you cannot sell it piecemeal. You cannot enjoy it. It's a rental property. Somebody else is enjoying it. You can't sell it when you want easily. You can't, let's say, even if you sell it, let's say for kids' education, you say that, okay, I will buy this property after 10 years, I will sell and fund my kids' college. You sell 200K, 300K, you got profit out of it. Now you have to pay capital gain tax, and then you have to worry where to invest this 300K, because all that you are not going to invest in 1 year. College education is 4 to 5 years thing. So now you win another problem. You got out of one problem and you land it into another problem.
समझा, बराबर है.
Rather, you have a planned portfolio in terms of equity and life insurance, permanent life insurance, and annuities and things like that. Hey, my child got a scholarship. I just need 20K. Okay, I will just take out 20K. I don't have to worry about the rest. I don't have to decide where to invest, how much is the tax implication, or nothing. I just take out whatever is needed, and rest is anyway, it's there, it's growing, it's there whenever I need it.
Okay. समझ गया.
Thank you, Prabhuji, for
Okay.
this seminar. A quick question.
Yes, sir.
You mentioned that we cannot balance the active income with the passive losses. Can we balance the passive income with passive losses?
Yes. You can set aside passive income with passive loss. So let's say you have two properties. On one property you made income and another property you made loss. So you can adjust it, but you can't adjust it active versus passive.
Okay, thank you, Prabhuji.
Hare Krishna, Prabhuji. Thank you
Yes,
for
Prabhuji.
the wonderful session. So, Prabhuji, I have a basic question. So, what is the best thing to, in US, to down the whole amount to buy a home or take the mortgage? What is the
It
best thing?
depends on situation, Mataji. It's a topic for altogether different topic, because lot of factors need to be taken into account, and that depends mostly on your personal financial situation and how much liquidity you have, what stage of life you are, why you are buying this house. It's a primary house or secondary house. Lot of those factors taken into account to decide whether it makes sense to put down or it makes sense to take a mortgage, and economic conditions and the rates and everything else. But one thing is sure, that you should not buy any property by putting less than 20% down, because then you have even a bigger risk in that case. So rule of thumb is that you should at least put 20% down for buying any property. Now I see people doing it 3% down, 5% down as well, but that way they are putting themselves into even bigger risk and higher cost over a period of time.
Okay. Thank you, Prabhu.
Yeah. Okay. Any other questions, comments, feedback, suggestion? Okay. So if not, we can end the session here. Thank you so much, everybody, for joining and giving your valuable time and association.
Vamshidhari Prabhu,
Yes,
I have one quick question.
Yes,
Not directly related to the real estate investment, but general question about real estate and tax filing.
Yeah.
So I'm living in a house and I have actually rented rooms in my house. So this rental income, I will have to show in my tax return as well, obviously.
Right.
But the problem is that I have not updated my address in my corporate, in my office people, right? I have not informed my office people. I have not given them new address yet. I just forgot actually. I moved here to this new house and I forgot to update the address. So and probably I have to act on it right away. Maybe in a week or two, I will go ahead and update it. But at the end of year, when I file my taxes, will IRS look at the address in the W-2, or how do they determine the number of days I have stayed in this house as to be claiming as a primary house?
It's based on, most probably it's based on the tax records and everything, because whatever you do, it's a public in US. Now you are just renting out a room, so that's a different thing, because I don't know you have any registered official document for that arrangement or not. But if you give out rental to anybody, then it's more or less public domain thing. If you buy or sell, it's more or less public domain thing. Anybody can search and anybody can find out how much you bought it for, how much you sold it for. So it's all public information. And for IRS to find out, again, in each and every country, the tax system works on good faith basis. And that's why you have audits. So it's always based on good faith basis that you are telling the truth and you are telling all the facts right.
Okay.
And it is for them to prove you wrong.
Okay. So it's not about the number of days my employer sees how many days I have.
No,
it's not with that,
has
right?
nothing to do with it. Yeah.
W-2, even the address listed on the W-2, does it have anything to do with my
may
primary
cause, it may cause some other issues, but I don't think in this context, but it's always good practice to keep all your addresses up to date on all your financial things.
Yeah, I will get my address updated, so W-2 will have new address.
Yeah.
But the number of days according to my employer.
No, that will go based on a good faith basis. And if they find something wrong and in audit, if they ask you to prove it, then you have to prove it maybe by utility bills and things like that.
Okay.
Yeah.
Sounds good. Thank you so much.
Yeah. Okay. So I think that's it for today. So next session, I will most probably try to cover the role of permanent life insurance, because naturally now it is flowing into that. So I want to give you full perspective on that, like how investing in permanent or life insurance is beneficial or not beneficial, in what scenarios it works, in what scenario it does not work, and what are the ways or what are the problems it can solve in terms of both financial security, in terms of tax planning, in terms of retirement stability, all those factors. So we'll look into that, and hopefully that would be a good session for all of you. And I will share the information in the community when I'm ready to do that. Most probably next Saturday, if not following. So it just depends on how much time I get in between. So we'll inform in community accordingly.
What will be the topic once again?
Role of permanent life insurance policies.
Okay. Yeah,
Right.
Yeah.
Hmm.
Yeah. Okay. So thank you everybody, and we'll take leave now. Guru Prabhu, you have anything to say?
Thanks, Prabhuji. I don't have anything, Prabhu. Yeah.
Okay. Okay. Thank you. Okay.
Thank-
Thank you very much. Hare Krishna.
Hare Krishna.
Hare Krishna. Thank you,
Hare
Prabhuji.
Krishna.